Hello everyone, welcome back to Fiscal Voyage. My name is Felix. In today's video, we're going to talk about two dividend stocks that I'm going to be buying that are high yield dividend stocks, and they've been paying dividends for quite a while. And I'm going to be buying them this Friday once I receive my work paycheck. And these two stocks, first we're going to cover is Verizon Communications Inc., ticker symbol VZ. I'm sure you guys are familiar with this in the dividend growth community. The company has a 6.56 dividend yield and a market cap of $170 billion market cap. And you can see here the 52-week range is on the high side here, close to the 52-week high of $43. But I'm going to show you why I'm liking this stock. So if we go to Fast Graph and go to Verizon stocks, you can see here earnings are expected to grow modestly at 3% in 2025 and 3% in 2026. However, first a down year this year, about 2%. So if they could actually make a flat 471 or 470 this year, that'd be pretty good. And I could expect the price of the stock to jump higher from where it is now. But even if it is stays consistent at 460 for this year and then 473 the following year, you can see here it could go pretty well if it were to revert back to a normal PE around 12.5, because currently the PE is at 8.7. So you can have a 21% annual rate of return for the next few years. But let's shorten this time period to a more realistic expectation around this here if it's growing at only a 0.45%. So you can see here this is based on a 0.45 growth, less than 0.5% growth, and we could still obtain a nice rate of return of 14%. It would to revert back to a P of 10. So even if it weren't going back to a P of 10, if it was going to a P of 9.4, you could get over 10 to 11% annual rate of return for the next few years. And the best part even if it's flat, you're still making 6.5 to almost 7% return. And I expect Verizon to continue to grow its dividend because the payout ratio based on earnings is still pretty good. It is expected to be at 58% for this year. And if we get an operating cash flow, you can see here operating cash flow is at 31% payout ratio. So that's real good. So that's why I like Verizon at this price. I didn't buy at the low 30s because I was thinking that maybe earnings would continue to deteriorate. But since they reported Q1 earnings, I'm liking what I'm seeing. So this is why I'm interested in buying shares on Friday of the stock. I own shares already. I'm down like maybe 10%. So I want to lower my cost average on that. The company is a BBB plus credit rating, so it is an investment grade. Long-term debt to cap is under 60%, which is decent. And the earnings yield, you can see here, 11.52, which is great. I like to see this at 6.5 or higher. So overall, I like this a lot. Forecasting long-term growth, you can see here is a slight 2% increase in earnings growth for the foreseeable future from 4 analysts. So that's real good. And you can see here, if it to revert back here in 2028, you have a 15% annual rate of return. So this is why I like this company a lot. So if we go to Morningstar, we could see some key metrics here in valuation. You can see here the 5-year average price to sell is higher than the current at 1.28. And then price to cash flow is lower at currently versus the 5-year average, and the price to book at 1.8 versus the 5-year average. And the PEG ratio is higher at 3.81 compared to the 3.64 on the 5-year average. So I like this a lot as good indicators of it's undervalued. And then if we go to Morningstar, even Morningstar says it's undervalued with a 4-star. It has a fair price of $54, and right now, as we saw here, it's going for $40. So you can see here Verizon is undervalued based on Morningstar, based on Fast Graph, based on these key ratios. And I also like to look at this here, some analyst forecasts from Morningstar. You can see her earnings are expected to continue to go higher at 451 in 2024, 464, 2025, and 26, 481, as well as the dividend is expected to continue to increase, even though it's just a penny per year, but it still increases. And what I like about it is I'm getting the income now, so that I could reinvest it in other stocks, and to create my my annual dividend income higher. I want to get to the $2,000 a mark per month mark pretty soon. Net margin is expected to increase also, so they'll be becoming more profitable. Analysts are expecting for the next 3 years. You can see here, price to earnings at the current price is still low, and that's why I like it. And we go to the charts. You can see here. So the blue line here in the monthly, this is the monthly chart, is the 13 moving average, and this right here, it broke the 13 moving average, and now you kind of use it as support here. And this is a trend change. So this is a change of trend. So I like this, and it actually bounced off the 200 moving average here. And another thing I like as well, in the weekly, you can see here in the weekly, this is the 50 moving average and the 13 moving average. So it's over the 50 moving average. It's possibly that the stock could go to $37 and then bounce from there. But I like it at the current price, so I would just buy some shares here, and then if it gets down to $37, I'll buy some more. But right now I do like it at this price. If we go back to the monthly chart, you can see here this stock bounced around the $30 range, and you can see why it bounced here. There's a big bottoming tail here on August of 2011, a big bottoming tail here. Strong buyer stepped up here around the $30 range, so this is why the stock bounced in that range. So that's why I like this stock a lot. So the next stock that I'm looking at is British American Tobacco. It has a 9.4 yield currently, and a market cap of $68 billion. And you can see here it's right in the mid-range of the 52-week average. So it's a little better than the Verizon. But if we go to Fast Grab, and I'll show you why I like this stock. BTI, wrong one. Here we go. So you can see here, historically, this company has been very well. If we move the price, it's been growing. You know, there's been some down years, but those years, you know, they continue to pay out the dividend. This change in dividend prices here, for example, is because of currency changes, because this is a British United Kingdom company. So they, you know, based on the dollar and the British pound, they fluctuate the dividends here. But overall, it is on an uptrend. Same thing with earnings. So we put price back. You can see here, this stock's been beaten down since 2018. It's gone as low as, since 2018, it's dropped almost 60%. So, you know, when I get a 60% discount on anything, I like it a lot and I want to buy it. So this is why I'm buying shares, more shares of this stock. I'm actually down as well in this stock. I own shares and I'm down about 10% as well. So I want to lower my cost average here. But you can see here, earnings are expected to grow down. It's supposed to be down this year, negative 1%, but then picking up in 2025 and 2026 very nicely in the mid single digit. Is a BBB plus credit rating and only 38% long-term debt to cap ratio. So if the company were to revert back to a normal PE of 8.7, which is still very low, you can see here a total annual return of 23% for the next few years. But if it to revert back to a more reasonable level around 14, here you can see here you have 45% annual rate of return for the next few years, while you're also collecting a 9.48% dividend yield. And the dividend is covered. You can see here operating cash flow covers the dividend. I think free cash flow as well. You can see here, yeah, free cash flow covers the dividend very nicely for this stock here. Forecasting long term, analysts are expecting about 4% earnings growth. So you can see here it's very undervalued. So this is why I'm interested in buying more shares. It would revert back a 10 PE multiple, 24% annual rate of return for the next few years. And even if it just stays flat and earnings continue to grow, you're collecting almost 9.5% in dividends alone. So this is why I like this company a lot. And then we go to Morningstar here. You can see here price to sell is lower than the 5-year average. Price to cash flow is lower than the 5-year average. The price to book is kind of it's a little higher than the 5-year average, but the PEG ratio doesn't show here. Long-term debt to equity is very good, under 1. This is great. And then if we go to Morningstar, you can see here it has a good 5-star rating with a fair value around $49, $50. So this is why I like the stock as well. And we go to the estimate analyst forecasting for Morningstar. you can see here, earnings are continue expected to grow. You know, in 2026, it's expected to be down year, $3.30 dollars per share, or British pound per share. But the dividend continue to grow, which is I like. And as you can see, overall, I like this stock a lot. And if we go to the chart, you can see here on the monthly chart, and you see here in the monthly chart, it's finding support here around the $28. If I draw this here, right there, you can see it bounced here, and then it bounced here during COVID, and now is fighting this support here. So this right here, this $28 is great support area. So this is why I want to buy shares. So we have matching the technical, matching undervaluation, matching key ratios and metrics. So this is why I like this stock a lot, and I'm gonna be buying some shares in Friday. So I'm looking forward to that. So that should increase my dividend income pretty good. I'm hoping for another maybe like a $200 increase for the year in dividend income. So that would be nice to see. So overall, that's what I'm going to be buying on Friday. Let me know if you guys been buying any stocks this week. You know, let me know what you're watching, what undervalued stocks you're looking at and looking to buy shares of. You know, maybe I could do a video of that as well. But let me know in the comments what you're planning to buy this week. And I'll see you guys on the next video, and make sure to hit the like button and subscribe to the channel if you're new. Thanks.